So our next speaker here, I got a quick story on this one. So when we have Mike Wood in from PetroShale, and when I was introduced to PetroShale a little over a year ago at 75 cents, I actually passed. I said, really, this company is public? And I said, here's a company that only has 1,280 acres in the Bakken, and they're not the operator. And I think I've drilled into everybody that you need to have operated acreage for the market to reward you. The market does not pay for non-operated acreage. And so I said, oh, it's really small. Management owns it all, which is good. And so I took a pass. And boy, did they show me. Over the next 14 months, these guys went out and did deal after deal after deal, got a huge chunk of operated acreage, and are hitting it out of the park. So after really kind of coming back to the story and seeing what the financials were in the Bakken, because now they're getting the same as WTI or even better, this isn't the old Bakken that we used to know. You've got way better technology, you've got a very focused team, and they've put together now a nice big runway, which has always been the hard part of the story. So now that they've got everything in place, I'm long the stock, and we're really lucky to have Mike Wood here to give us the full update.
Thank you, Keith. Appreciate it. Thanks for having us here. I asked Keith, I guess a lot of you haven't really heard about PetroShale, so I'll be the new one to the block here. I'm glad to tell you how we're doing. Okay, so we're quite unique. PetroShale, our stock's actually doing quite well. I think we're one of the top performing stocks on the Toronto Exchange last year. And why we're so unique is that we are a Canadian listed company, but we have no assets in Canada, and everything we do is in the US. So we have an office in Denver where our operations staff is. Everything we drill is in the Bakken only. We're 100% Bakken Tier 1 focus, but listed on the Toronto Exchange. So a lot of our investors, the majority are in Canada, but they are playing a pure play US play through our stock. But we're traded on the TSX, symbol PSH, 150 million shares. Our stock, when this was printed, was 205. We're now in the 220s, so we're up another 10%. Enterprise value about $460 million. Our fourth quarter production was about 6 million BOE per day, and that's a growth of about 53% quarter over quarter. Our total proved reserves, and we do have our reserves are done by a third party, Netherland, Sewell, so they do a full reserve determination, not an audit, with a PV10 of a little less than 500 million. And these are all Canadian values that I'm giving you here. So what about PetroShale? What are we doing here? So we're pure play, like I was saying. The Bakken is going through a renaissance mode. In the past, there was just the Bakken layer, and then below that called the Three Forks 1 layer. Now we have the Three Forks 2 that's under full development, and the Three Forks 3 is also being exploited. So a stacked oil play out there. So 4 targets, and we're focused on the top 2 at this recent juncture. So that before the drilling campaign that we just had, we had 1 operated well, which we drilled in 2016 and came on in at the end of 2016. And then we started the drilling program in late of 2017, and those wells have just came on. So 4.5 net wells have just recently came online. And that took our production from in that 2,000 BOE per day range to now we're at 6,000. So with each of these wells coming on at 1,000 barrels a day, it doesn't take a lot of wells to increase our production significantly. We have, and I'm going to talk about some of the things on here. So we have a lot of development opportunities coming up. We have strong inventory going forward, and we'll be kicking off a new drilling campaign in Q3 of this year. One of the other things that we did, and which was strategic, is that we brought in a financial partner with First Reserve. So with our upcoming drilling campaign and continuing to do acquisitions, we ended up bringing First Reserve as a capital partner. First Reserve is one of the largest PE companies out of the U.S. We're their only Bakken investment, but they are been about a 30-year company with billions of dollars under play. So so what's going on with the history of the company? So this kind of walks you up, and it kind of talks about Keith, where the company for a long time was quite small, non-operated only, and the company's doing well. They went out and did about 57 deals that were non-op, and they focused on Tier 1 acreage in the Bakken, and specifically with operators EOG, Interplus, and Slauson. And the company has done well there. Prior to that, in 2013 and 2014, before we got in the Bakken, they were in an exploration play called the Mondak play, and that was an exploration play that didn't work out very well, but then migrated to the Bakken Tier 1 in 2014, and from them we've grown quite rapidly. I joined the company about a year ago. The reason I came on board is, again, to help transfer this company from a truly non-operated company to one that has both non-operated and operated. And with the gist that we wanted to try to control some of our growth, if companies like EOG were not drilling on our properties, we wanted to make sure we could supplement our production with our own operated production to hit the guidance we've been given Wall Street. So joined in June 2017, as I mentioned, drilled the 4 wells and did a financing with First Reserve. So who's on PetroShale? So I've got a list here of the management team and the board. So Bruce Chernoff is our chairman of the board. I think many of you in here know Bruce. Bruce has had a great track record, having built several companies from the ground up and sold them for, in some cases, for billions of dollars. But founder and built Pacalta, Petrobank, Petromineralis, Harvest Energy. So Bruce brings a lot of expertise to the board. In addition to Bruce, myself, President CEO, we've got Tony Izzo here, who's in Calgary at the back of the room, and then my VP of Land, Dom, Nick Pallone, who we got from Kodiak. So Kodiak Energy was one of the largest Bakken producers. We were able to pry him away from them, and Dom has been instrumental in the number of deals that we've done up to date. And then David Rain is our CFO, who's also based here in Calgary. Now, one of the things that I like about our board is that these are very seasoned CEOs of very successful oil companies. Many of you will know Brett Herman, President and CEO of Torque, Ken McCarty, CEO of Westbrick, Jacob Orda, former CEO of Harvest, and then we have Brooks Shugart, who's on our board, who's a director at First Reserve. So a very savvy board that's very involved in oil and gas development. All these guys are doing acquisitions and drilling and giving great guidance, and also giving me some goals that I need to meet every quarter that I appreciate. So here's kind of a picture of how the company has grown in the last 3 years. On the left there upper is our reserve growth. We're currently, based on our reserve report at the end of 2017, have about 37 million barrels. That's a growth of about 44% the last 2 years, and with an NPV of 493 million. And the key from this slide is at the bottom there, you can see that 55% of our net future locations are operated by PetroShale. That number was much, much, much lower 18 months ago. And then the other thing is that our non-op stuff, so a lot of people get non-op interests and nothing happens to them. But of our non-op interests, 28% are controlled by EOG, Slauson, and Interplus, but of the non-op, 75% are held by these companies. EOG, Slauson, and Interplus are very active in the program. A lot of people, when they look at PetroShale, they consider us as Interplus Light, which means we're based in the same area that Interplus is in, but don't have the Marcellus and the Canadian assets. We're a pure play. They're very active, so our non-op activity is being drilled. So just today we're fracking 4 wells with an operator called MRR, where we have a 40% working interest. So our non-op continues to grow at a very good pace. Recent corporate accomplishments, as I said, the $75 million strategic financing we did in January. What we did with that was we had a mezzanine financing. We also had an RBL that was fully drawn. So through the financing of First Reserve, we were able to pay off the mezz and the RBL down to 0. And that investment by First Reserve is a preferred share with a 9% dividend and a conversion to 240 in the near future. So what that says, if First Reserve, they have certain internal targets. I'm guessing private equity is shooting for 20 to 30% rate of return. So if their conversion's at 240 and we're trading at 225, that tells us that they're very confident in the growth of the stock going above 240 to meet their own internal rates. So that was a very strategic financing. What First Reserve also brings to the table, you know, they're multi-billion-dollar private equity companies, so they are now a financial partner that we could use to pursue even more acquisitions of greater size. The largest one we've done to date has been about $18 million. But with First Reserve, we can look at deals that are much bigger. But we're going to just focus on Tier 1 rock. So there's a lot of stuff in the Bakken we can buy, but again, if it's not Tier 1, we don't buy that. Recently, in the acquisitions that Keith kind of alluded to, we did 2 in 2017 for $12 million, and then we just closed 1 in Q1 of this year for $17 million. Those 2 acquisitions increased our operated acreage by over 300% from what we had before. And then we had the RBL was increased to $50 million US that we can use to help fund our drilling. And then the company, just prior to me joining the company, they did have an equity offering in April of 2017 where the stock rolled out at 90 cents and it was oversubscribed, and those guys are real happy as our stock's trading above 220 today. So a very good return for our new shareholders. So what's the Bakken look like from a cartoon standpoint? Let's see. Okay, that slide's not in there. Okay. So let's go to our inventory, and then I'll show you how the geology looks. So this is a map of what we have in the Bakken. So our acreage is shown in yellow. The green area that's shaded there is the reservation. So in North Dakota, the Tier 1 rock is located on what's called the MHA Reservation. And the MHA Reservation is made up of 3 different tribes. Each of them, that's what makes it the MHA. In the green is 2 fields called the Antelope Field and the South Berthold Field. That's where Interplus is 100% concentrated. That's where we're concentrated. WPX is concentrated. Where EOG is concentrated. So when you hear about the Bakken results coming out in the 2,000 to 3,000 barrels of oil per day, first 30 days, it's happening in those 2 fields. And that's where we've been concentrating our acreage. Again, Tier 1 rock. As you look inside that black outline and in the green, those are the 1.2 million EUR wells. And if you go to the west, which on here would be going to the left, then you go down to 800,000 per well, and then take another 5 townships further to the west, and you get down to that 5 to 600,000. So the Bakken has 15,000 wells in it, and you pretty much are going to hit that 500,000 barrel per well. But if you're in the Tier 1, it's a 1.2 million and higher, based on the latest results we're seeing. So in our inventory right now, PetroShale assuming an 880 spacing, and that's basically 6 wells in the Bakken, 5 in the Three Forks, and then another 5 or so in the Three Forks too. We have 60 net locations. We are drilling approximately 6 to 8 net wells per year with a 1.5 rig program. So we have an inventory of at least 6 to 7 years already identified. And this doesn't include locations that we are now putting together on a couple more operated units that will be drilled later on this year. So good inventory. Real excited. We have a lot of drilling ahead of us to do. The other thing that we're excited about is that the Bakken is developed on both 2-mile laterals. So many of the laterals are 10,000 feet long, but many laterals are 5,000 feet long. So it all depends on how the leases were put together, either a 1280, which are stacked 2 640s, or 640. But of our inventory, 66% of our wells are 2-milers. So the 1-miler wells, you're looking at EURs in Tier 1 of 800,000, and the 2-milers 1.2 million per well of BO. So this is kind of a geology of how things look. On the left there is kind of how we're looking at the Bakken right now, the 880 spacing. So the upper zone there is the Bakken. You see 6 wells in there. Then the TF1 and TF2 are illustrated there with another 6 wells in that and 5. The slide to the right, there are other operators that are drilling at a much higher density. We're kind of focused on that 11 to 15 wells per drilling spacing unit, but there are others doing 21 to 22. Companies like Halcon, QEP, Hess are drilling at much higher densities, and we're going to continue to watch that. But one thing that we do try to do is we preserve the geometry that we can come back and add some wells in the future, even with our 6.5 spacing at this time. But that's kind of how the sandwich looks for what we're doing in the Bakken. So what are the economics like? This is what's exciting. These are the type curve economics, and we benchmark our type curves to other operators. So what you see here is very similar to what you'll see from Interplus, WPX, EOG, Marathon, Continental, Whiting, some of the big producers. But again, some of them are not in the tier 1. But our drilling and completion costs are about $8 million. That's for a 2-mile well. EUR 1.2 million BOE. Our IPs come in at about 1,200 barrels of oil per day, average first 30 days. So if you look to the right, and we have 2 different type curves, the Antelope and South Berthold, you can see at 55 WTI, in our 2 fields, we're getting IRRs about 60 to 140%. And these are half cycle, and if you were to do full cycle with all the land costs in there, just take 20% off of that. So instead of 60 to 140, we're 40 to 120% IRR. So that's very robust economics. The differentials that we're assuming here are $4 per barrel. And as Keith said, you know, the Bakken 5 to 7 years ago, you had dips of 20. I just finished a marketing roadshow in Toronto, New York, and one of the things that the messages we got from the investors were that they are looking at the Bakken now as having better economics than the Permian. And the reason being the Permian Basin now is having very high challenges when it comes to egress, and that some of the guys were predicting that the differentials in the Texas could go from $20 to $30 a barrel. In the Bakken, and I'll have a slide at the end showing the egress, we have lots of capacity. So the $20 a barrel we had 5 to 7 years ago dropped to 7 to 8 when rail came about, and then the Dakota Access Pipeline was finished, thankfully to a U.S. president who is very pro-business, got the final leg of that pipeline online within 45 days of taking office, and the DAPL, Dakota Access Pipeline, now dropped the diffs down to, we're seeing about $3 now. Over Christmas, we actually were at $1 premium to WTI. So the diffs are making a huge difference, especially with the Bakken, making it more competitive than what we're seeing in some of the other basins that we compete with. So this is a pretty busy slide, but what it illustrates is some of the offset production that we're seeing in the area. At the upper left there, we see the word E+, that's Interplus. So you can see 30-day IPs, 2,500, 2,300. Then to the middle right of the slide, Marathon with IPs of 2,700 barrels a day, 2,500 barrels per day. So the takeaway here is that, you know, our yellow acreage, we're just assuming a type curve of 1,200 barrels of equivalent per day, and you're seeing that the offset guys are doing 50% more than that. And we haven't changed our type curve. We do produce our wells in what we call slow back. So we, for example, the last 2 wells that we brought on that are in this slide, which would be in the upper right-hand corner where it says PSH MB. So in that DSU, we brought those wells on, and we've kept those wells at a 30/64 choke. And those wells have been consistently producing between 1,200 and 1,500 barrels per day. So we don't open the wells and gut them. I could open them up and report 2,300, but we're keeping them pretty flat at that average of about 1,300. So we park it at 30/64 and then manage our pressures going forward. So that's some great results and some of our offset operators. Then there's a similar slide then for the South Berthold. Same takeaway here. You can see there's a lot of data there for Interplus EOG showing IP30s between 1,500 and 2,500 barrels of oil per day. And again, our type curve assumes 1,200. So lots of upside in what our plan is. And of the 4 wells we've drilled, 2 are right on the type curve and 2 are materially above. So pretty excited about our results of our first 4 wells. So going forward, as I said, we're going to complete the 3.7 wells were completed in Q1. We had our March production of 5,300 barrels of oil equivalent per day. We currently are above 6,000 barrels per day. We're continuing to add our acreage positions. So one of the niches that we have is that because we're a smaller size company, 100, 200 acre positions are very material to us. We have a lot of experience working, our staff has with the reservation. So a 100 to 200 acre position in a 640 could lead to us operating a 1280 by getting ahead of the curve and getting our permits in from the smaller working interest owners. So we'll continue to add to our positions. In 2018, we'll drill 9 gross wells. So the rig, we have 1 rig that starts next month and another rig that will start at the end of August, and we'll continue drilling into 2019. Average cost per well, $8 to $8.5 million. Our goal right now internally is to be between 8,000 and 10,000 barrels of equivalent per day in Q1 of next year. So we doubled our production in the last 6 months, and we look to double our production again in the next 12 months. And one of the great things about the Bakken is it, you know, I've got a lot of years here in Calgary. I've helped build 2 companies that are still here that are some of the top gas producers in Canada. And it does personally pain me on the gas prices in Canada, but if you took the netbacks that we get in the Bakken, so if at $65 oil, we're netting about $40 a barrel. So if you're making 5,000 barrels a day in the Bakken, you're bringing in about 200,000 revenue, net cash flow coming in there. So it's equivalent, if you're in Canada making gas, it's really sad. That's a 400 million a day cubic feet Canadian gas company. They're clearing about 50 cents. So, you know, the oil economics in the U.S. and the netbacks are just so powerful for strong cash flow. So with these wells that we're drilling, you know, just 5.3 net wells, we're, like I said, going to go to 8 to 10,000 barrels a day and have very, very strong cash flows as a result of that. In addition, our non-op units continue to be drilled, and as I said, we are fracking 4 wells today that we have 1.6 net wells in. So to illustrate the diffs that I talked about earlier, this is a diagram that shows the takeaway capacity out of the Bakken. The black line there is what the Bakken production has been since 2007. So the Bakken did peak out around 1.2, 1.3 million back in 2015. And as you know, prices changed, so the production came off, but we're right now at about 1.1 million with capacity of about 1.3 through pipelines. But remember, the rail capacity is there too. So a lot of people are committed to moving oil on rail because they signed long-term contracts. So the basin has easily built-in infrastructure to take 2.5 million barrels of oil out of the basin, and the total basin is making about 1.1 million. So egress is not a concern for us, and we think that'll also keep the differentials in that $3 range going forward. So in summary, we are a pure play North Dakota Tier 1 Bakken producer. We have a large number of drilling locations based on our current activity load of 6 to 8 net wells per year. We have 6 to 8 wells of drilling to do, 6 to 8 years of drilling to do. We recently brought on 4.5 net wells, took our production up to above 6,000 barrels equivalent per day. And we've continued to demonstrate that we can do acquisitions to add to our current location inventory. And we did a strategic financing with First Reserve that, again, given us a very strong balance sheet and ability to do, continue doing acquisitions, but also on a much larger scale if the right opportunities come along. And we've got the transformation from non-op to operator. It's going well. Like I said, we gave guidance to the street that we would be at 4,000 to 5,000 BOE per day in Q1 of this year, and we're at 6,300. So we exceeded our guidance by almost 30 to 40%. So with that, I'll be glad to take any questions from the audience about our company. Yeah, it's all the above. I mean, one of the things that we've, like, for example, the operated unit, the first one the company had, which is called the premise unit, that started off with a very small interest. So we definitely continue to do non-op deals for a number of reasons. One, in North Dakota, You can force drilling to be done, and so you have a strategic say at the table if you have an interest in a DSU that's not being drilled. So we see the non-op interest as something, as a catalyst to get activity. Whether it's non-op or op and we're getting wells drilled, it's almost agnostic to us, but we do have the operated stuff in there because we do want to hit the targets that we've been telling Wall Street. The reservation where we're on, it is harder work. One of the companies that I was a founding CEO of, Rimrock, we started off in Calgary. And Rimrock was a Warburg Pincus-backed company, and we were looking at deals in Canada, and we decided to go into the U.S., and we thought the Bakken was the best place to do. So their entry was they bought all of Whiting, which is one of the largest producers in North Dakota, bought all their properties on the reservation. So there are companies that do not do work on the reservation, but what's interesting about this reservations, I've worked in Canada for 10 years in BC with the West Moberleys and Sinuichi tribes. I've done a lot of work with reservations in Canada. I've done work with reservations in Wyoming. And the difference between those reservations and the reservation in North Dakota, there's 3 tribes on the reservation. If the guy in the other tribe has a new pickup truck, this guy wants a new pickup truck. So there's not one Indian or native culture that's driving the decisions. There's 3 different tribes who want money for their tribe. They want to be competitive with their neighbors. So they get a royalty for every oil and gas barrel produced on the reservation. They get a royalty. So they have an economic incentive to get activity. They also get surface payments, and they get right-of-way payments. So there's a lot of wealthy people on these reservations, and they do promote that they get wells drilled on their property. Now, the difference is because it's an Indian reservation, the Bureau of Indian Affairs, the BIA, is involved, which is a federal government entity, and the BLM, Bureau of Land Management, is involved, so, and the MHA is involved. So if you're off the reservation, it's a state of North Dakota, that's it. If you're on the reservation, it's state of North Dakota, Bureau of Land Management, Bureau of Indian Affairs, and MHA. So it takes about, instead of 2 months to get a permit, about 4 to 5 months to get a permit, so you're adding about 2 extra months, but it gets done, it gets assigned, and you do pay a little more money through fees through the reservation, but you're in the best rock. So we will continue to grow on the reservation where a lot of others won't, because we feel the economics are worth the extra sweat equity that has to be put in. Yeah, absolutely. So I've come from a reservoir engineering background. So the key in the Bakken, for example, in our premise, those 2 wells that are making both over 1,200 barrels a day after 2.5 months, we have about 1,000 GOR, so we have a lot of gas. If you open the wells to 64, that gas will break out near wellbore, and you don't get that lifting mechanism. So what we're doing is by choking the wells back, we're keeping the gas in formation, and hence that's helping with the pressures and avoiding what we call liquid drop-off near wellbore. Other companies that do what we call the slow back is Interplus has adopted this too. They also choke their wells back. Companies that don't is EOG. So EOG has very high IPs, but you know, we see benefits in after 6 months where we do see shallower declines in some of the people that open wells up. So it's just something we'd rather have a shallower decline up front and hit our CUM 12-month goals than to have a high IP30. You know, it's interesting in the Bakken. So the biggest players in the Bakken right now is Conoco, WPX, EOG, Marathon, and of all those, they have big operations in the Permian. So those guys are parked in that 2 to 3 rig pace, and even when oil went to 70, they didn't change anything. The only large operator that has, and then Oasis also has big Permian. Whiting is the only big operator that has only Bakken to deal with. So I think what we're seeing is in the Bakken, even though economics are greater, none of those companies are increasing their rig count because the Williston, in the Bakken, there's 15,000 wells already drilled. So that land is HBP'd. They don't have to drill it. So one well will hold 1,280 acres until that well stops producing. Where in the Permian and the Delaware, where those companies have big land holdings, a lot of it recently purchased, they must drill to hold the acreage. So I would say that they're kind of keeping the Williston flat loaded, so that hasn't put pressure on rig costs. They've kind of stayed pretty flat. The only area we've seen cost creep is in the sand cost. But pretty much the number of frac crews and the number of rigs there hasn't changed much in the last 6 months. We're much busier than we were a year ago, but I think those operators are kind of parking at a certain base load because they don't have to drill if they don't want. It's HBP'd. Unlike the Permian, where I've heard the service company will say, this is the price, give us your best price. And from some of my friends I talked to, they're paying about 30% more in some cases for the same frac job because they don't have a choice. They have to hold their acreage. We're not seeing that in the Bakken at this time.
Mike, thank you.
Oh, you're welcome. Thank you, Keith.